Imagine you lend money to a friend. They need it for something important, maybe to start a small business or to pay for an unexpected expense. You trust them, so you hand over the cash. They promise to pay you back with a little extra for the favor. This extra amount is their way of saying thank you for helping them out when they needed it. That's a bond in a nutshell. It's essentially a loan, but instead of lending to a friend, you're lending to a government or a company. In the financial world, bonds are loans you give to governments or companies. These entities need funds for various projects and operations. They use your money for various reasons like building roads, schools, or hospitals, or launching new products and expanding their businesses. In return, they promise to pay you regular interest payments like your friend's extra cash. This interest is usually paid at regular intervals, such as every 6 months or once a year. And after a set period, known as the bond's maturity date, they return your initial investment. This period can range from a few months to several decades. It's like a win-win situation. They get the funding they need to achieve their goals, and you get a steady stream of income from the interest payments. Bonds help fund important life events, like buying a home or paying for education. They provide a reliable source of income that can be used for significant expenses. They also support community projects and new businesses. The money raised through bonds can be used to build parks, improve infrastructure, or help startups grow, and they can be a key part of planning for retirement. Bonds offer a stable and predictable income, which is crucial for retirees who need to manage their finances carefully. Bonds provide financial security and peace of mind. They are a safe investment that can help you achieve your financial goals and ensure a stable future for you and your family. Government bonds are like the rock stars of the bond world. They're issued by governments to fund public projects. Think of them as the most reliable borrowers because they have the power to tax citizens to repay their debts. Government bonds are generally considered low risk, especially those issued by strong economies. They offer stability and are a popular choice for conservative investors seeking to safeguard their capital. Types of government bonds include treasury bonds, municipal bonds, and savings bonds, each offering unique benefits. They provide regular interest payments and can be a reliable source of income. For those looking to preserve wealth and enjoy peace of mind, government bonds are a solid choice. Company bonds, also known as corporate bonds, are issued by businesses to raise capital. Unlike government bonds, company bonds carry varying levels of risk depending on the company's financial health. Investing in a company bond is like betting on its success. If the company thrives, you benefit from higher interest payments. However, if the company struggles, your investment might be at risk. Factors affecting the risk levels of company bonds include the company's credit rating, industry stability, and overall economic conditions. Examples of company bonds include those issued by tech giants, manufacturing firms, and retail chains. Understanding these factors can help you make informed investment decisions. The yield curve is a graph that shows interest rates for bonds with different maturity dates. It's like a crystal ball that provides insights into investors' expectations about the economy's future. A normal yield curve slopes upward, indicating higher interest rates for longer-term bonds. An inverted yield curve, where short-term rates are higher than long-term rates, can signal an economic downturn. A flat yield curve suggests uncertainty, with similar interest rates for short and long-term bonds. Investors closely watch the yield curve to make informed decisions about their portfolios. Historical yield curves have been reliable indicators of economic cycles, helping investors anticipate market changes. Section 5. Interest rates. The seesaw of bond prices. Interest rates and bond prices have an inverse relationship, like kids on a seesaw. When one goes up, the other comes down. This fundamental concept is essential for anyone involved in the bond market to grasp. When interest rates rise, the prices of existing bonds fall, and vice versa. This happens because new bonds are issued with higher interest rates, making the older ones less attractive. Imagine you buy a bond paying 3% interest, and then interest rates increase to 4%. Suddenly your bond is less appealing because new bonds offer a better return. Your bond becomes less attractive to other investors because they can get a higher return elsewhere, causing its price to drop. This is a critical point for bond investors to understand. Conversely, if interest rates fall to 2%, your bond paying 3% becomes more attractive, increasing its price. investors will flock to your bond because it offers a better return than the new bonds. This seesaw effect is crucial for bond investors to understand, as it impacts the value of their investments. Knowing how interest rates affect bond prices can help you make better investment decisions. Always keep an eye on interest rate trends to make informed bond investment choices. By staying informed, you can anticipate changes in bond prices and adjust your investment strategy accordingly. Remember, the bond market is sensitive to economic indicators and central bank policies. Regularly reviewing these factors can give you an edge in predicting interest rate movements. In summary, understanding the relationship between interest rates and bond prices is vital. It allows you to navigate the bond market more effectively and make decisions that align with your financial goals. Section 6. Bonds in action. Real-life examples. Let's say you buy a 10-year government bond with a $1,000 face value and a 2% interest rate. This means that the government promises to pay you 2% of the bond's face value as interest each year. You'll receive $20 in interest annually for 10 years. This interest payment is typically made semi-annually, so you might get $10 every 6 months. After a decade, you get your $1,000 back. This is known as the bond's maturity date, when the principal amount is returned to you. Now, imagine investing in a company bond with a higher interest rate, but a greater risk of default. Corporate bonds often offer higher returns to compensate for the increased risk. The company's financial health will determine whether you receive your interest payments and principal back. It's crucial to research the company's credit rating and financial stability before investing. Consider a municipal bond, which often offers tax-free interest income. These bonds are issued by local governments or municipalities to fund public projects. These bonds fund local projects like schools and infrastructure, providing community benefits. The interest earned on municipal bonds is usually exempt from federal income tax and sometimes state and local taxes as well. Diversifying your bond investments can balance risk and reward, ensuring a more stable income stream. By spreading your investments across different types of bonds such as government, corporate, and municipal bonds, you can mitigate potential losses and enhance overall returns. It's also important to consider the bond's duration and interest rate environment. Longer duration bonds are more sensitive to interest rate changes, which can affect their market value. Consulting with a financial advisor can help you create a bond portfolio that aligns with your financial goals and risk tolerance. Section 7. Risks and rewards. Every rose has its thorns. Just like any investment, bonds come with risks. Inflation can erode the purchasing power of your interest payments, and interest rate changes can impact the value of your bond holdings. Company bonds carry the additional risk of default. Government bonds are generally safer but offer lower returns. However, bonds also offer potential rewards, providing a steady income stream and diversification for your investment portfolio. High-yield bonds offer higher returns but come with greater risk. Section 8. Bond Investing 101. Tips for beginners. If you're new to the bond market, start by understanding your risk tolerance and investment goals. Consider diversifying your bond holdings across different types and maturities. Research bond funds or ETFs as a convenient way to invest in a basket of bonds. And remember, consulting a financial advisor is always a wise decision. Stay informed by reading financial news and understanding bond ratings. Set up automatic investments to regularly contribute to your bond portfolio. Use investment apps to track your bond performance and make adjustments as needed. Section 9, the last word, bonds in your financial journey. Bonds play a crucial role in a well-rounded investment strategy. They offer stability, income potential, and diversification benefits. By understanding the basics of bonds, you can make informed investment decisions and navigate the exciting world of fixed income securities. Remember, every investment journey is unique, so invest wisely and enjoy the ride. Bonds can be a cornerstone of your financial journey, providing a steady path to achieving your goals. Embrace the power of bonds and let them guide you towards financial freedom.